Federal Reserve today, big news from the Fed, cutting rates by 50 basis points. David Russell, Global Head of Market Strategy for TradeStation.com, is joining me on the Scott Sancho. TradeStation is the platform I use to trade futures. Although, David, I stayed completely away today. I lost about $50. I think I took a gamble right before the announcement and thinking, okay, if it's 50, I think the market's going to fly. I was wrong. So just a small micro ES trade went awry, but lose small. If you're going to lose small, I think. So I blew that. I thought it would fly at 50 basis points.
Well, I think we came into it overbought. We've been up for 6-7 straight days. And, if you think about it, we had just tested that old high from July. So I think it's pretty incredible when you actually consider that this is typically the weakest time of the year. Last year, especially after that Fed meeting, the market, entered a pretty significant, 1 to 2 month pullback. So I think people have been definitely, kind of looking at that and thinking if there is going to be a time that we're going to see weakness in the market, this is it. So I think there has been a bias in that direction, and we'll see if it goes much further than just this one minor pullback today.
Well, the saying has always been buy on the rumors and sell on the news or something to that effect. And I think the 25 basis point cut has been anticipated for so long, it's been baked in that there was going to be a reaction one way or another to whatever the news was today.
Yeah, I think absolutely. And the fact is that this was very well telegraphed and, well, not say telegraphed, but well expected. And at the end of the day, there are some other issues that come out of this, which is the fact that, we've seen this idea that lower interest rates is good for certain parts of the market, like banks and small caps and a lot of these other areas. But the problem is it's not necessarily good for your mega cap growth stocks. And as a result, we're seeing some rotation here just beneath the surface of people saying, you know what, as I look out for the next few months, what's going to benefit from this environment? It might not be Apple or Nvidia. And given their size in the market, that just creates an overall drag on the bigger indexes.
I want to come back to that in a second, but the 50 basis point cut today from the Fed, what do you think was the motivating factor behind that? Conspiracists are going to look at 48 days away from an election and think, well, this has got to be politically motivated. And let's be honest, politics are involved in every major decision like this. Gas prices are lower today than they were 3 months ago for sure. Interest rates coming down 2 months before an election, a weird coincidence, I get that. But I think that perhaps the Fed had realized that they were a little behind the curve, a little slow to react in raising interest rates. And if we are headed towards a recession, they don't want to be late cutting the rates either.
Well, they were late fighting inflation, and exactly, they don't want to be behind the curve a second time. And I think that's a big part of it. And when you look at the messaging, I would say that today was the last few weeks, we've seen a really significant transition here of a concern about of employment that we've not seen before. If you actually look at Powell's statement, he placed much more emphasis on supporting employment and much less emphasis on being worried about inflation. So I think we can actually say now that the Fed has, cast its attention largely from inflation to now largely supporting employment. And it's a very important change. And I think, people were surprised. They didn't know what a hawkish Fed felt like back in early 22. It's a shock. And I think we have to realize now that it might actually go the other way. And we've been so used to them being hawkish that they seem to be telegraphing a pretty clear pivot here.
Explain, if you would, and we're talking to David Russell, TradeStation.com, the correlation between the interest rates and the employment market and the job market, and why when interest rates are high, there are more unemployed.
Well, on one hand, it basically makes it harder to engage in business in general. I mean, things like construction are going to be slowed down by that. And when people think that interest rates are going to be lower or higher for a long time, then, executives and people who are going to be hiring, they're going to say the economy is not going to be great 6 months from now, so I'm not going to hire today. And I think that's the big thing. It basically is about shaping the expectations and basically sending a message to those people who are in the decisions of hiring and making orders and making plans. And when they do certain things, it impacts employment, and that impacts, incomes and things like retail spending. So that message of higher rates has finally kind of gotten through, and the economy really has slowed enough here, and there's slack that now I think the Fed can actually be looking the other way toward the idea that there is some risk here of the employment market weakening, and they don't want to be missing that, in terms of a slowdown.
That's the negative, but because it does slow the economy, it's theoretically also going to bring down inflation.
Absolutely, and I think it has at this point. And there's several different things that are happening here, and I think the fact is that by having higher interest rates, it has reduced construction and has reduced a lot of industrial activity, and that has diminished employment, and that has slowed down inflation. And then the other thing is I think that we have a situation here where the Chinese economy has slowed a lot, and that's actually having an impact that a lot of people, I think, are not appreciating enough. But we're seeing a real kind of weakening in demand for things like energy, and energy also, that sort of thing is going to be associated. Higher interest rates will reduce demand for commodities like energy, and that in turn will turn around and lower inflation.
I'm not going to hold you to this projection, David, but what are you hearing? What's the speculation about what the Fed may do over the next few months? Do you expect them to cut by another 25 basis points at the next meeting? And I think I heard someone say 4 cuts over the next year. Is that possible? Is that a good thing?
4 cuts over the next year seem very reasonable. The next meeting, I'm not sure. I'd have to really analyze the cadence of things. I think the thing is that the Fed funds now is 2.5 percentage points above CPI, the inflation rate. And that is a high number. It's the highest since 2007. They had raised interest rates back in 2006, 2007, and lo and behold, it caused a recession. So the fact is that they know where they are now, and they also don't see a reason to stay here, given what we have seen, the reduction of hiring and a lot of other measures of the job market, weakening.
So did I hear you correctly say that the Fed's actions caused a recession?
Well, it definitely, the slowdown and the housing, there's a lot of things. I'm talking back in 2008,
right?
Where they had been raising interest rates, and that helped to really slow down the economy, which then turned into the financial crisis, which was actually caused by bad loans that were out there. But once the recession, kind of turned, then those loans went from being bad to being insolvent, and that's when the whole thing blew up.
David Russell, Global Head of Market Strategy, TradeStation.com, here on the Scott Sand Show. So you talk about the large caps that may be affected by the change in the Fed positions. I'm looking today at the heat map, and I see that Microsoft and NVIDIA are certainly red. They're down. Apple was up, but not by much. Amazon, some of the other stocks, some of the banking companies, Visa, MasterCard, JP Morgan are all down. We've got 60, 90 days before the end of the year. We're going into Q4. We'll have another earnings report before the end of the year. How do these companies react, and how do their shareholders react?
Well, I think right now they're in a difficult position to a certain extent, because if you're looking at the bullish economy, so to speak, in terms of, because I think the economy actually has some real areas of strength. Look at the retail sales this week and some other things. If you're looking to reposition, for what the economy could be doing in the next 6 to 12 months in terms of lower interest rates, a lot of these big technology companies don't give any clear exposure to that new trend of lower interest rates. So it creates a degree of sort of heaviness on them. And I think when you look at it, things like the semiconductors even as well, these things are now focusing on something like AI, and a lot of that is now in the market, and the price action has not been very bullish in them. So I think we do continue to see here the risk of some rotation, and these other areas of the market, utilities and, real estate and industrials and financials, those sort of areas that have been strong. That is where the momentum has been, and there's a reason for it. And, there's really no reason to immediately think that's going to change. I think this year is broken. Kind of the first half was AI. The second half could be everything else. And I think we're in that spot now where all these other areas do well. And it could be frustrating, though, for people who are focused on the mega caps.
What about some of the stalwarts, some of the traditional blue chips? And I'm obviously not going to ask you to recommend or comment on specific companies, but generally when inflation is up and the economy is suffering, companies I'll mention like Coca-Cola, Procter & Gamble seem to do well. Do you expect this to have the inverse effect on companies that would traditionally be safe harbors for investments?
Yeah, a lot of those relationships have broken down. I would say that there has been a shift toward things like consumer staples, like you just mentioned, because they had lagged for so long. And I think that the normal deployment of capital away from, this hyper concentration that we've seen in the large growth stocks, could continue to favor some of those other areas, things like financials and things. When you look out into the future of what the impact of lower rates would be, and things like that, things like financials are likely to be an area where people look. Industrials are likely to be an area, and even some things like material stocks, because there's things like packaging companies and chemical companies that can benefit. They're not just all stocks that are exposed to China. So I think that there is, something here where people are going to rediscover America. I would almost say rediscover housing, rediscover retail, things like retailers going into year end. Some of these forgotten retailers, they're in a spot now where they've been closing stores. They're in a spot where they have pricing power, and they're going into a holiday season. So from my perspective here, we're in a spot where people are looking for new things, and some of the new things might be the old things. It might be going back to where we were 15 years ago, of retailers and autos and stuff like that.
Just an aside, I can't believe after 78 years, Tupperware is going bankrupt. Did you see that story? That's amazing.
Wow. No.
It's an iconic brand. I don't know who owns Tupperware. I don't think it's a publicly traded company. Maybe it is. But I can't. The Tupperware going bankrupt story kind of shocked me when I saw that earlier today. David Russell, Global Head of Market Strategy for TradeStation.com here on the Scott Sand Show. TradeStation, a trading platform that I use. I missed my play on the Fed earlier. I'm going to look in after hours, extended hours, maybe in the middle of the night to see how the Japan markets are reacting and see what the futures do. But tell everybody about TradeStation if you're a retail trader and how the TradeStation platform works.
Well, if you like to trade a lot and actively, TradeStation is really made for you. And I think that we focus on futures at the beginning. Now we have a real sort of very interesting offering for people who want to be trading stocks, futures, and options. And that's all our bread and butter. We're looking for active traders who like to trade a lot. And there's a lot of things that you can find on our website about our execution and our pricing and things like that. But it's a great place to work. I've loved the platform for a long time, and it's an honor to be able to represent the company.
Well, David, it's great to have you on the show. I appreciate your insight.
Thank you, Scott. It's good to see you.